Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. Today we have back again a special guest, Ian George. Thanks, Ian, for coming back.
My pleasure.
And I wanted to ask Ian some more questions on this high early cash value life insurance that exists and how to apply its strategies to our everyday lives and some of the needs we had where we wouldn't have understood really how to utilize this. So thanks again for coming in. Can you get into some explanation on how individuals can really apply some of these strategies?
Absolutely. So as we talked about the high early cash value, just to give a quick recap, that's essentially a whole life insurance contract offered by a company where they say, what we're going to do is we'll take anywhere from 85 to 90% of your first year premium, and it goes directly to cash value. So the example we used, for example, I'm going to use $10,000, and that as soon as you pay your $10,000, $9,000 appears in the cash value, and obviously you have your death benefit in place.
Okay.
Where this becomes an interesting tool for individuals is that, especially for older individuals, a lot of questions that we get come down to the fact that older individuals hear about whole life insurance strategies. Not often, but they're actually becoming more and more popular. I do laugh that whole life insurance is now becoming more popular, 165 years after its invention. So, but the interesting thing is that older folks tend to say, well, I'm out, because I'm too old to use whole life insurance in terms of what would go on. It takes too long for everything to build up and work for me. Okay. There is some validity to that with certain types of strategies. There's certain types of strategies that do take longer periods of time to really manifest themselves and work effectively. Okay. However, with this particular strategy, it can be very appealing. So if you have somebody who's entering in retirement, just getting ready, who's really looking hard at retirement or who's actively in retirement, this strategy using the high early cash value can be something that's attractive. Because what we find out, especially in our area, Western PA, we're a conservative group. We tend to we want to know where our money is. We want to know what's going on. We don't have a lot of wildcats in terms of what goes on with, investing on that. We have our share, but by and large, as a population, we tend to be pretty conservative. So one of the things that comes up with that is that we run into people who have large amounts of cash in vehicles like CDs and savings accounts, and even in checking accounts. So with CDs, those tend to ebb and flow. You might have a chance to get some, interest on that. Not in recent years, but as interest rates rise, there can be chances for that to grow more. But it's really the security that has attracted those individuals and the access to it. So for an individual, they're looking at what's going to happen on a legacy basis. So their plan is to say, I have X amount of dollars, and I say, I have, there's an account over there that has $100,000 in it, and I want to give that money to, it could be a child, a grandchild, and one of the questions that we ask is, for example, why haven't you given it to them already? A lot of people, their number one concern for not having done that already is, what if I need it?
Okay. I see that with charities too.
Right. So people can be a little bit concerned. I want to do this. It's every intent that I have, but I don't have a crystal ball. And long-term care could be a concern down the road. Or I don't know what could happen, if something happens to my house. I don't want to give my beneficiary, my child or grandchild, money and then either have to go back to them or find myself strapped because I shouldn't have done that. So that's one concern. The other concern that I hear often, which is interesting, is the belief that the individual they're giving the money to is going to blow it, and they just don't want to be around to watch that. So Valid is the other. So it's everybody has their reason for holding on. It's their
That's
cash.
more true. I laugh, but that's actually more true than.
Right. And they don't want to be in judgment of what people are doing with the money they gave them, but they can't help themselves.
Right.
So so what they're doing is they're looking to preserve this. They don't want it to go anywhere. They don't want it to go down, which generally means these individuals have no interest in putting this into an investment.
Okay.
They don't ever want to look, if I'm using the $100,000 example, they don't ever want to get a notice on that account that says it's one dime less than the $100,000 that was in there.
Okay.
So with that, what we find is that they can start to be more comfortable that the idea of doing this transfer over time. Now, we're not going to take $100,000 and plop it in this policy.
Right.
We're going to do it over time through premium payments. And you can structure those. So, for example, for an individual like that, we might structure a contract that's paid over 10 years, or depending upon their, maybe 15 years, something along those lines, so that it equals that amount, so that they can see as their money's going in here, they have all their liquid here, and then obviously 90% of what they put in is over here.
Right.
But it also comes with a nice death benefit that's going to be obviously far greater than the $100,000 that we're talking about.
Okay.
So hypothetically speaking, let's say they're doing this and it's creating a $175,000 death benefit. So if something were to happen to that person, in the first few years, they'd have the cash going to their heirs plus that, higher death benefit.
Right.
Plus, if they need their cash, they can look and see where it all is. It's now in two buckets, and the majority of it, over time is going to start to be here, but fully accessible as we talked about in the past.
Okay.
So the nice thing is if you got through that transfer period, and let me just use 10 years that we structured it that way. At the end of year 10, they'll have as much, if not more money in the cash value of the policies that they have complete access to. Even if they access that cash. So now we're assuming that they've started to use some of that money because something did come up.
Right.
Well, they're now drawing down for legacy purposes for what they're giving.
Right.
They're drawing from their death benefit. So whatever their cash is. And so in my example, let's say there's $105,000 in cash value and $175,000 in death benefit.
Right.
If they needed $50,000, they take out $50,000. Well, now what's going to the family is going to be starting at $125,000, $50,000 from that. So even if they're using this, what they're still giving is greater than what they would have been giving if it had stayed in a cash type of account.
I see.
So those can be very effective contracts for individuals who really want to give a little shot in the arm to upgrade their gift without letting go of the safety aspect of their policies.
Right. There's some tax planning benefit there too. When you think about it, we get into a lot of people in high income situations in retirement where they're subject to the Medicare tax. If they just cross over this limit, by shifting assets over here, it's under the tax radar, lowers their AGI, maybe to enough as a tax planning strategy where they're still earning money on here. It's still working for them, but it still helps on the current taxable situation also sometimes.
That's true. The other aspect too is when, for example, in Pennsylvania, we have I call it the death tax. So that if, money's moving, down generations, there's going to be a little bit of a bite taken out. It's not a huge number, but it's a percentage and it's going to be paid out.
Right.
Death benefits don't fall under that scrutiny. So a death benefit moving to an individual does not carry that bite that Pennsylvania gets.
Okay.
And there are different levels, obviously, of that tax for children, non-children, grandchildren.
Right,
the numbers all vary, but they're all avoided.
But
with
it
the
is
death
one that
benefit.
a lot of people want to try to avoid. I get asked that a lot.
Yeah, I mean, I don't know that I would restructure my whole plan of trying to avoid the Pennsylvania death transfer tax. However, if I can do something and as a side effect that I get to save that extra
That's
money to
my
my
point.
thing,
That's
absolutely,
my
I would
point.
do that.
That's my point.
Why pay more when you don't have to?
Exactly.
So that can be a very effective strategies for a lot of those individuals, and we do see more and more people doing that, primarily because they know that they want to have this gift be the gift, but if they can make their gift bigger and not give up what they're worried about depending on, they get to have both.
Again, it's leveraging cash that may have been just set aside to keep safe, right?
Correct.
And keep relatively liquid if they need it.
Yeah, absolutely. So that works out well. Now the other thing I will tell you too is that we can take a look at what goes on, because most of these policies have available to them other riders that can be put on this policy or any other type of whole life policy. Those riders can create enhancements. So you're going to want to talk to the insurance company or take a look and see what the insurance company has to even enhance it. So you have your base premise, which is a pretty good idea of something that can go on. You might find out that there are ways to make that even more attractive.
Now, even before we go there, when we look at cash, and as you said, sometimes it's just basically we want to protect against maybe if we need it for a nursing home or something. So if I have $100,000 in cash, it's worth $100,000 benefit toward covering the cost of a nursing home.
Correct.
But if I shift that $100,000 in cash over time or all at once into a leveraged policy like this, and if it meets all my other needs, and if it's maybe only a percentage of all of my other assets, I might have leveraged that benefit up to possibly be a long-term care replacement asset for my spouse. So I go into a nursing home, and maybe the nursing home costs $175,000 is lost out of our estate, but I have a $175,000 death benefit to my spouse, of which I only paid $100,000 for, then I've in fact possibly leveraged my $100,000 benefit to replace $175,000 that was lost. So it doesn't always work, but that is a concept of leveraging money, not as a long-term care alternative, but as a long-term care replacement of assets.
Correct.
Possibility, and it's tax-free when we do that. Okay, so, and that's even without any riders. That's
Correct.
just inherent basics of how the structure of leveraging cash works through this.
Yeah, exactly. And it's funny when individuals grab hold of that concept, they realize how much leveraging they can do. So how much replacing they can do overall.
Exactly.
One of the things that you see is that if we're using $175,000, anything that's being spent that I know that's coming in, that gives me permission for nursing care, anything along those lines, to know that I can actually have that's going to be coming in.
Right.
The way I describe how people can visualize leveraging is, if somebody on Friday had a winning lottery ticket and they had $300,000 in their savings account, and they had a winning lottery ticket on Friday that they drew, and they knew that on Monday they were going to get $1 million. What I ask people is, would that weekend, would you spend that the same as all other weekends, or would that $300,000 now come into play for something fun to do? The answer is that $300,000 is now coming in play. Yeah. They're no longer worried about protecting that $300,000. Why? Because they know come Monday they're getting $1 million.
I see.
Well, when we take a look at, this is a little less fun because of what we're talking about.
Right.
But if I know that I have a death benefit, and this is where death benefit in retirement as a tool can come into play, but if I know that upon my death, my spouse or my heirs are going to get this death benefit, that gives me comfort in using what I need to use today to know that it will be replaced upon my death, that I'm not leaving somebody in jeopardy. So in your example, you used a great example, a little uncomfortable about using the care, long-term care in terms of what I need to pay for out of pocket, but my comfort level with that and the ease can come along with that, knowing I have a death benefit to replace that when I'm gone.
That's important. I've seen that before, and I've seen we can't afford to take a trip because we this or that, and it does help leverage. It's the key word. It's leveraging money, allowing you to have more than you actually have by restructuring. That's very good. What about these Riders.
So there's a number of different, every insurance carrier has different riders that come with whole life insurance contracts that people have options
That are
for.
available.
Right, that they have options, yes, exactly, that are available. So one of the ones is, depending upon the age of an individual, is the waiver of premium rider. The waiver of premium rider, if somebody is still in their working years, it's something that I really think is important because it's a little disability policy. So what that means is that if somebody becomes disabled and is unable to go to work, the premium is essentially waived. With whole life insurance contracts, what that means is that your policy is growing as though you were paying your premiums. So it becomes kind of self-fulfilling.
Okay.
So if you had somebody, for example, in their 40s who was creating a plan, and a part of their plan was using whole life insurance contracts, what you would find out is that if something were to happen to them and they lost their income, that plan continues on uninhibited. So that's disability insurance for that person would be very important for income replacement, but this plan would be taken care of on its own and continue to grow. That's one.
Is that subject to creditors?
No, generally speaking, it is not, because it's the life insurance policy in and of itself. Every state has a different way of how that can be protected, but the majority of states protect the cash values of permanent life
So
insurance.
what we could say, at least there's a possibility that that asset might stay intact, even if you run into creditor problems because you were disabled and had no income, losing everything else. It might offer some protection.
Correct. That's a fair statement. The other one, to tie back into what we talked about, we were just talking about, is actually a long-term care access rider. A number of carriers have these as well, where basically what they say is your death benefit can now be accessed while you're living to pay for long-term care.
I see.
So in our example, that
not
we
just
had,
the cash value, the death toward the death
correct.
benefit. Okay.
So what's interesting about that is that if you had somebody, and let's say we have the widow Smith, and she is managing her own money and has everything going, and she wants to leave money to her her children or grandchildren,
Right.
But she's very conservative and wants to know where it is. So we talked about that high early cash value,
Right.
or we talked about what whole life could do in general terms. Well, the other thing that could come in with these riders, if this carrier has this rider, is she could now be accessing the death benefit. So in our example, to go back, we had $100,000 in cash, and we had using it over time to buy a $175,000 death benefit.
Right.
Well, if she required long-term care, she's now working for long-term care at $175,000 or a portion of that to pay for long-term care.
How? How does she access
So
it?
she files a claim, just like you would with a regular long-term care policy, and if she qualifies, if it's cognitive or if she can't complete any two of, usually it's a list of 7 activities of daily living.
Okay.
So she's qualified for long-term care. I'll use the most common, because 80% of long-term care claims are cognitive,
Right.
meaning someone's just not sharp.
Yeah.
So the doctor has said it's not safe for her to be alone.
Okay.
There you go. That just triggered a long-term care policy.
Okay.
That would trigger this as well. So what happens is, as used in most cases, or in some policies, they just turn it on. So the different policies work differently, but generally they're going to start drawing down from that $175,000 death benefit. So now, for her individual money, she's turned $100,000 into long-term care of $175,000.
As opposed to the reason a lot of people don't like to plan for long-term care is we don't want to pay the premium for a long-term care policy a lot of times and then never need the policy and all that money was wasted.
Right.
Where in a life insurance policy, we know we're getting the benefit.
Somebody is.
And now you're saying we, with a rider available, might have access to that death benefit in advance for our for meeting our current long-term care expense needs. Okay, so that's double duty. I like that.
Yeah, so that can be a nice effect there. The other rider that is often used And it has different names with different carriers, which is unfortunate. That's what the insurance industry does best, is call the same thing different things every time they get a hold of it.
Okay.
But the most generic name for it would be a paid-up additions rider.
Okay.
And essentially what that is that's taking your base policy and having the ability to push cash directly to cash value.
Okay.
So I'll use my example of the the $10,000 policy
Okay.
with the $9,000 going to cash value.
Right.
And this can be used on other types of whole life insurance policies, as well. But what happens is I want to push in $11,000. So now I have $11,000 going, my $10,000 is on my base. That $11,000 is essentially going directly to cash value.
Oh, you can do that?
Yep. So if people want to shorten their time frame or do something along those lines, but they just like where this is, they have a way of putting money directly into it on top of their base policy.
Okay, that's good.
And pushing money into that.
Yeah.
The only thing we ever look out for when we do that is a policy becoming a modified endowment, or a MEC. All that means is this. The IRS takes a look at these policies and says, this has got to have the semblance of life insurance. If it becomes an investment account, we're going to tax it like an investment account.
Okay, which means the earnings would be taxed.
Correct.
Currently taxed.
So we keep an eye to make sure of what people are doing, to let them know this is the limit of what we can put in here to keep your tax protection on your cash as well as the death benefit.
But that's very interesting because, again, back to my tax planning strategy, where we're allocating assets, this is a tax strategy. It should not be bought for that, I'm sure. But there are auxiliary benefits to have an extra $1,000. If I shift this, I lower my AGI, I'm over by a couple $1,000. What do I do to avoid the Medicare tax at 3.8% or whatever? And here, or someone, there are many different reasons for tax planning, but it's nice to know that some additional can go in, but there is a limit to that.
Yep.
Yeah.
It's very effective.
Okay, that's good. That's a good one.
The other rider that is available out there and this is something that everybody has to take a look at for themselves, but there is a way to blend term into whole life, to mix them all together. Different carriers treat this differently, and I have a recommendation that I'll get to in a minute. But basically what it says is, I'm going to buy a whole life insurance contract, but I want more death benefit. I want cash value, but I want more death benefit that's coming with this base policy. Mm-hmm. So they buy this base policy, and they buy the basic term that's going to be there as well. So as an example, let's say they want $1 million. They buy a $600,000 whole life contract, and there's a blended term rider that they put in there for $400,000. Well, that gives them $1 million. Their base policy is here, at a $600,000 policy plus the term.
Okay.
That gives them $1 million. Most whole life insurance policies, when you watch them over time, the death benefit's growing.
Yes.
Because those are the dividends are buying what they call paid up additions. We talked about that paid up additions rider, but essentially they're little paid up policies that are being tagged on top.
Okay.
With these types of policies, that's not what's happening. Those dividends are being used to convert more of that term to whole.
Wow.
So at a certain period of time, and it could be, you can set it with carriers, you can tell them when you want that to, all convert. But you could have it be that at age 90, I want this all to become whole life insurance. So every year, that $600,000 of whole life is growing in its whole life amount, and the term is becoming less and less and less.
Okay. And is that built into the premium? And is that premium standard then? I mean, that continues
Correct.
At the same rate?
Yep. So your premiums now, the tough thing about this is that that conversion is dependent upon dividends.
That's what I was wondering.
So
too.
your base premium, in our example, for your $600,000 is guaranteed. With whole life insurance, with base whole life insurance policy, premiums are guaranteed. There's underlying guarantees on cash value, and death benefits guaranteed. All costs and effectiveness within those contracts, 100% guaranteed.
Okay.
because the dividends, which are not guaranteed, okay, once they're paid, they're guaranteed because you were given it. No one's ever going to come back and ask for them back.
Okay.
So, but once they're in, they're guaranteed. But you can't guarantee a future dividend.
Okay.
So, what happens though is because the term is being converted by those dividends that are not guaranteed, your premium
I see.
isn't necessarily guaranteed for what that relationship is to the term. So, for example, if you bought a policy like this and dividends were very high, so you bought a policy like this in the mid 80s when dividends and interest rates and fixed was all very high, and dividends came down. Right. What you might find out is that the dividends weren't able to convert that term on a schedule, so now you owe extra premium so that you can convert it.
Or you lose, does that term insurance start coming down, or you lose it entirely, or what?
Well, that's up to you. So some carriers permit that you can actually start to shave off part of the term.
Okay.
So they treat it as a separate rider.
Okay.
Some carriers blend them. So you're in for a penny and for a pound. So with this type of rider, most carriers offer the rider, but you want to know how that's treated, what kind of flexibility you have a choice of. Yeah. And there are a number of carriers that do allow it to stay separate, so you have much more control over that if anything ever happened. But it can be a nice way to have a policy that has growing the cash value that you want and juice your death benefit. The other thing you can do too, conversely, is you can accelerate that conversion. So in my example, let's say you got a big raise and a job change and you said, I need another place to put more money. The policy, that $600,000 base isn't enough. I need to convert more. You could say the next year, make all 400, let's change that, make it all whole life insurance right now, or 200 or 100 of it. You can immediately convert that over with the vast majority of the carriers that are out there.
Any other riders?
So the one other rider that I wanted to touch on too is the transfer of insured. Now, it's not a rider that costs money, but it's a rider that people might want to be aware of, especially depending upon the settings and what they're using their policy for. And what a transfer of insured means is that I can actually take a policy and remove the individual from that policy and put somebody else in that policy.
Who's the insured?
Who becomes the insured. So
on whose death the policy proceeds get paid.
Correct. So you can use policies. That often happens in a business atmosphere where you have partners that are set up and somebody leaves and says, no, let's do this. So for example, if you have a partnership set up, let's say it was between you and my son was coming into the business, well, instead of me leaving with the life insurance policy, it might make more sense for my family dynamic of what I'm trying to build to have my son become the new insured on that policy so that he enters the company ready to go, and then my deal's with him of how he's going to buy me out of that half of the company.
I got it.
But that transfer of insured policy is always something to look into because there are a number of unique aspects that you can use that strategy for in terms of replacing the actual insured on the policy.
One of which would be, does that affect the premium because it's a younger insured in that father-son case?
It absolutely can affect the premium. You might find out that the son is stepping into a policy that's pretty much done, that could be paid up, because all that cash associated with that younger age, could do it. Or it could push up a death benefit. Maybe it's time for a much bigger death benefit.
So there is flexibility there. That's interesting.
Right.
I like that.
So you get all the credits for it.
Yeah. Ian, thanks again for coming in. We're out of time again today, but can you share with everyone how they can get a hold of you? And go ahead and feel free to contact Ian with any questions or to look into your own situation, own individual circumstances, see if he can help you out.
Absolutely. I can be reached at 412-969-0111.
Thanks again, Ian. Appreciate your coming in with all your ideas, strategies, and tools.
My pleasure.
And we'll be back again next week with another edition of All Things Financial. Thanks for tuning in.